Thanks for clicking. Is Canada going to follow the United States into a recession? This is the big question being asked north of the border after the United States announced it had its second quarter in a row of negative GDP growth. While the White House and U.S. Treasury Secretary Janet Yellen say the U.S. is not experiencing recessionary conditions, 2 consecutive quarters of negative GDP growth say otherwise.
You are. He is.
Despite the apparent definitional issues, the big question for us north of the border is Canada going to follow suit? Given that our own GDP numbers show that for the second month in a row, Canada's economy has failed to expand, combined with the recently inverted yield curve, these are definitely reasonable concerns. So what I want to do today is go over Canada's historical GDP and interest rate policy compared with that of the US, showing how the two are very closely linked. Then I want to talk about Canada's inverted yield curve and what that means for our economy. Then we'll take a look at what to look for next. We are expecting the release of Canada's updated inflation rate for the month of July on the 16th, which will obviously weigh heavily on the minds of the Bank of Canada when they make their rate announcement early next month. We'll obviously have updates out on that on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into Canada's economy. Whether or not the US is currently in a recession or experiencing recessionary conditions remains to be seen, but what is certain is that as the US economy slows down, Canada is almost certainly to follow suit. If we look at the graph offered by the Financial Post, we see that the economies of the United States and Canada tend to follow one another in lockstep. Sometimes the United States leads and Canada follows, and sometimes it's vice versa. But we can be assured, looking at this graph, that when the United States economy falls, Canada is not far behind. And if we look at the history of the interest rate policies of both the Federal Reserve and the Bank of Canada, we can see that those two merge together as well. For the last 60 years, but especially for the last 20 years, when the US raises rates, Canada follows suit. We can see throughout this graph that our interest rates move basically in the same direction. When the economies are overheating, both the US and Canada raise rates to cool it down, and when the economies are slumping, they lower rates to pump money back in. And this has continued well into 2022, with the Federal Reserve raising rates to a funds rate of between 2.25% to 2.5%, and the Bank of Canada just recently raising our policy rate to 2.5%. So the cost of borrowing is getting more expensive in both countries, leading to a slowdown in the United States.
Everything that guy just says is bullshit.
And judging from the data, Canada is not far behind. We've seen 2 months of consecutive job losses in Canada, and we've also seen a major increase in the amount of personal insolvencies, up 15% in Toronto this year and up 11% nationwide since this time a year ago. So historically, our economy has followed that of the United States. Our interest rate policy has followed that of the US historically and this year. And we are already starting to see more and more job losses and more bankruptcies. And then last week we saw Canada's yield curve invert. Very basically, a yield on a bond is how much money investors can expect to earn on that bond. In normal times, we expect the yields on longer-term bonds to be higher than the yields of that on shorter-term bonds. If you lend me money for 30 days, you're going to want to get a much bigger return on your money than if you were to loan me money for 1 day.
I'm not giving you any money.
So in general, in a normally functioning market, we would expect the yields on longer-term bonds to be higher than shorter-term bonds, as investors expect a higher risk premium on longer-term bonds. For the first time since 1994, we saw the spread between Canada's 2-year bond and its 10-year bond go up by 50 basis points as the yield curve inverted. So the yields, the amount of money made on bonds, are higher for a 2-year bond than they are for a 10-year bond, meaning investors are demanding a higher return on a 2-year bond than they are on a 10-year bond.
It's very generous.
Not quite. The yield curve has inverted as investors are getting more and more concerned about the effect of these higher interest rates on Canada's economy. In fact, investors expect the economy to experience such a downturn that after 2 years, they are expecting the Bank of Canada to have to lower rates, have to reverse course on their interest rate policy, And as such, they are expecting that we will see lower interest rates after these 2 years. When the bank does reverse course, the investors are thinking the yields on those longer term bonds, the amount of money that can be made on those longer term bonds, will shrink. So when we see an inverted yield curve, it means that investors are thinking the Bank of Canada is going to reverse course on interest rates due to a recession in the economy, due to a major slowdown in Canada's economic growth. And I think it's worth noting that the US yield curve inverted sometime last month and continues to remain that way today. So investors, not only in Canada but also in the US, are expecting the central banks, the Federal Reserve, to reverse course once this recession gets bad enough. So in summary, if we look historically, once the US enters into a recession due to our close economic ties, Canada is not far behind. And we're already starting to see signs of a slowing economy, with more and more job losses, with an increase in bankruptcies, and we just saw an inverted yield curve. So there are certainly a growing number of signs saying Canada will be following the United States into a recession. We're raising rates just about at the same pace as the United States, and we're already seeing the effects of those rising rates with increasing number of job losses and insolvencies, and we've only been raising rates now for about 5 months. So we're still at the early stages of this rate hiking cycle, and as we've talked about in other videos, although investors are expecting the Bank of Canada to be reversing course once the recession hits, I'm just not so sure that's the case. We will have a better idea of the pace of the bank's interest rate policy once we get the inflation data out this week on the 16th. We will have updates out on that inflation rate on this channel. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.